Okay, thank you, Seb. Good morning, everyone. Sorry, after that sort of more accessible version, a slightly drier set of remarks for the aficionados. But I'll start with the same message, as you would expect, that a decade on from the start of the financial crisis, G20 reforms are building a system that's simpler, safer, and fairer. The real economy is beginning to realize the benefit of these reforms. Credit's now growing in all major economies, while the cost of financing has remained low. Sources of finance are increasingly diversified between banks and markets, and the system's dampening shocks rather than amplifying them. My letter as FSB chair to G20 leaders, which is being released today alongside the FSB's annual report to the G20, sets out addresses three issues. First, what's been achieved, particularly with respect to fixing the fault lines that caused the financial crisis. Secondly, what remains to be done in order to fully secure the benefit of the agreed reforms for the real economy. And thirdly, what's next, including scanning the horizon to address new risks and evaluating the coherence of the reforms in order to ensure that they function and the system functions as well as possible. Looking to the future, G20 countries now have a strategic opportunity to build on this foundation to create a truly open global financial system, a system that will support the necessary cross-border investment for strong, sustainable, and balanced growth, which, after all, is the objective of the G20. So let me start with the first question: what's been achieved? We fixed the fault lines that led to the global financial crisis through, first, better quality and higher levels of capital and liquidity for banks, thus making them more resilient and more resolvable. Secondly, global policies to transform shadow banking into resilient market-based finance. And thirdly, reforms to the over-the-counter derivatives markets that are replacing a previously complex and dangerous web of exposures with more transparent and robust system that better serves the real economy. Starting with banks, the largest banks are now required to have as much as 10 times more capital than before the crisis. And we're in a position now where all the globally systemic banks have met their 2019 Basel requirements well ahead of schedule. To bring back the discipline of the market and to end reliance on public funds, FSB members have agreed all the international measures needed to end too big to fail, and they're making good progress on implementing them. For this summit, these standards are being augmented by guidance to be published this Wednesday on how global banks' internal total loss absorbing capacity can support cross-border loss allocations in resolution, as well as guidance to ensure that as banks in resolution are being restored to solvency, they can maintain access to financial market infrastructure in order that those banks can continue to supply their critical economic functions. Despite this progress on resolution, practical work remains to ensure that resolution regimes are still truly effective cross-border. Turning to shadow banking, following a series of measures that eliminated the toxic forms of shadow banking, the FSB is now working on transforming the remaining shadow banking activities into resilient market-based finance. Back in 2013, the G20 agreed the FSB's proposal for a shadow banking roadmap, and that roadmap was designed to implement a comprehensive framework to strengthen the oversight and regulation of shadow banking. And today we're publishing an assessment of the policies that have been put in place under that framework. We're reporting to leaders that, as a result of their reforms, the toxic forms of shadow banking at the heart of the crisis no longer represent a global financial stability risk. Moreover, the remaining shadow banking activities are now subject to policy measures which reduce their risks and reinforce their benefits, allowing for more diverse and resilient forms of market-based finance. Now, having said all that, of course, shadow banking activities will inevitably evolve. So FSB member authorities will continue to strengthen their surveillance, data sharing, and analysis in order to support the risk assessments and any future regulatory response that may be required. Turning to derivative markets, a decade ago, OTC derivative trades were largely unregulated, they were unreported, and they were bilaterally cleared. When the crisis began, uncertainty about exposures contributed to the panic. At the 2009 summit in Pittsburgh, G20 leaders initiated a fundamental overhaul of these markets to reduce systemic risk, to improve transparency, and to prevent market abuse. The FSB is delivering to the Hamburg Summit a review of these reforms. In fact, it was published last Thursday. And that review concludes that a decade on, meaningful progress has been made in reducing systemic risk as a result of advances in trade reporting, central clearing frameworks, and new capital and margin requirements. I'll give one example. The amount of collateral covering OTC derivative counterparty exposures of global banks has risen by more than $800 billion, and the coverage of exposures by collateral has risen from 1/3 to over 2/3. Now, central counterparties, or CCPs, have intentionally been put at the center of efforts to reduce systemic risk, and it's obviously important that they, too, don't become a new source of too-big-to-fail risk. To reinforce existing standards, on Wednesday, the FSB will issue guidance on CCP resolution, and on the same day, CPMI IOSCO will issue guidance on CCP resilience and recovery. Turning to the second question of what remains to be done, I'd like to highlight 4 areas in particular. First, Basel III must be completed urgently and then implemented faithfully. This will lock in the benefits of the more resilient international banking system that's been created. It will provide regulatory certainty so that banks can lend and invest, and it will level the playing field through consistent international standards. Secondly, the asset management sector has become increasingly important in recent years. It provides new sources of funding and investment, and it reduces the reliance on bank-based funding. By 2015, asset management accounted for over $75 trillion of assets globally, or 40% of total financial system assets. To give you the contrary, a few years prior, those numbers were 30% of total financial system assets and $50 trillion. So it's a fundamentally positive development, the rise of asset management, if I can put it that way. But at the same time, there are some vulnerabilities associated with certain aspects of it, in particular with respect to open-ended funds with attendant run risks that have grown alongside that general growth. So in January of this year, the FSB issued a series of recommendations to address liquidity, maturity, transformation, and leverage risks associated with the sector. IOSCO is now operationalizing these recommendations, and we will report back to future G20 meetings on whether they're having their desired effects. The third thing that remains to be done looks at OTC derivative markets, where trade reporting of those markets has increased, the transparency of those markets, but there are steps needed to make trade reporting truly effective. In particular, last week, we published a report on work to remove certain countries' legal barriers to full reporting, and we expect urgent action to address the remaining barriers by the agreed date, and that's a G20 agreed date, of the middle of next year. Fourth, a series of initiatives are helping to address the underlying causes of misconduct, and they're focusing on bolstering individual accountability and better aligning incentives and rewards with conduct. But more needs to be done to break the recent over-reliance on ex-post fines. To this end, tomorrow the FSB will publish a progress report on actions being taken to restore public trust in the financial sector, in particular to strengthen financial institutions' governance and compensation practices, to improve standards of conduct in wholesale markets, and to reform financial benchmarks so they're less susceptible to manipulation. In the next phase of this work, the FSB will explore ways to increase individual accountability of senior managers in order to prevent individuals with record of misconduct from moving between firms and to promote governance frameworks that address cultural factors that foster misconduct. So what's next? Of course, reforms can't be static. Financial systems will evolve and authorities must respond. Implementation brings insights about which reforms work well and where they don't. And the FSB's approach of dynamic and effective implementation will help ensure that the new regulatory framework keeps pace and adapts accordingly. Our latest annual report to the G20, which is being released today, looks at implementation and the effects of reforms, and it sets out the progress made and the issues outstanding. Now that reforms are more fully in place, we're increasing our focus on evaluating their effects. That work will be supported by a new framework for evaluating the effects of reform, which will inform us to make adjustments where necessary. An early application of this framework is expected to be a review of whether the interaction of reforms, including derivative reforms and the leverage ratio, is appropriately incentivizing central clearing of OTC derivatives. Turning to new and emerging risks to financial stability, we are studying the financial stability implications of the rapid growth of fintech. We're looking at addressing the implications of the withdrawal of corresponding banking services in vulnerable countries, and we're catalyzing industry to improve disclosure of climate-related financial risks. On fintech, our report published last week sets out the opportunities and risks from a purely financial stability perspective, as you'd expect. It concludes that while potential risks to financial stability are well covered by existing frameworks, we will continue to need to monitor developments closely. In parallel, the FSB is currently conducting a stocktake of regulatory and supervisory frameworks to guard against cyber threats. On correspondent banking, the FSB is pursuing a 4-point action plan to address the issue of so-called de-risking. And tomorrow we'll publish a progress report and results of a data survey that highlight the continued withdrawal of services and the regions where the challenges are the greatest. On climate-related financial risk, we would like to thank Michael Bloomberg and the members of the Industry Task Force on Climate-Related Financial Disclosures. Last week, they published an excellent set of recommendations that can help transform market understanding of climate-related risks and opportunities that companies face. Although this was catalyzed by the FSB in response to a direct request by the G20, this is a private sector, industry-led effort. These are recommendations for the market, by the market. And the market's responding. At the launch of the report, CEOs of over 100 leading global companies with market capitalization in excess of $3.5 trillion and financial institutions controlling assets of over $25 trillion announced their support for the task force work. To conclude, G20 countries now have a strategic opportunity to build on the strong foundations of agreed standards and increasing international cooperation to create a truly open global financial system. Doing so would further support the cross-border investment needed for strong, sustainable, and balanced growth across the G20. The FSB's collaborative, consensus-based approach has been instrumental in achieving this progress. It's essential that we continue to reinforce this momentum by encouraging full and consistent implementation of the agreed reforms. Secondly, strengthening cooperation, including better information sharing. Thirdly, considering how we can leverage our progress in support of an integrated and open system. And finally, by applying the new framework for evaluating the effects of reform and responding accordingly. So with that, I'll thank you for your attention, and Svein and I would be very pleased to answer your questions.
I'd be grateful if you put yourself to one question in the first instance. If we have time at the end, I'll go back round. I'll also take a couple from the phone lines in due course. Questions? Yep, one down here.
Thanks very much. Philip Alexander from Risk Magazine. Just a little bit about resolution and TLAC. How far is it possible to tell whether some of those tools are going to work until you actually have to use them?
Well, we're seeing some smaller applications of some of those tools. We've seen some instances in Europe recently, which is not, these were not globally systemic institutions, but one sees some of the issues which I would say have been anticipated in the design of TLAC and also in the design of internal TLAC that can challenge resolution authorities. So there's an element of learning by doing. But to your question, can you definitively predict how the tools are going to work for the largest globally systemic institution in advance of its in advance of an actual need to use them. No, you can't perfectly predict it, but you can learn from logic, you can learn from smaller trials that happen naturally, and they will happen from time to time, particularly as there is real market discipline being enforced now. And then the third thing you can do, and authorities are doing, particularly those authorities in the largest jurisdictions, the jurisdictions like the UK, the US, and now Europe that are home to most of the globally systemic banks, is to have tabletop exercises. Some call them war games. I'd prefer the former description, to look through how authorities will react. We have had, the UK authorities have had several of these with their American counterparts, and now the European authorities have joined them.
Yeah, Hugh Jones, Reuters. In your video and in your opening remarks, you mentioned how you're solving too big to fail. We had TLAC and all that now. Yeah, I mean, do you think the rescues we've seen in Italy recently send out the right message, where taxpayers are on the hook, and the whole point of the G20 reforms are to keep taxpayers off the hook forever? And secondly, have you given up totally on deeming asset managers systemically important?
So on the first question, I think it's extremely important, speaking as chair of the FSB, important to think about the timelines for these reforms. So the agreement on TLAC was designed, and the sequencing of the TLAC agreement was designed so that institutions, and I'm speaking about the largest, most complex global banks, those institutions have time to build up the debt, the bail-inable debt, at the right, not just to the right level, but also that it's issued from the right part of the corporate structure. So if you're a single point of entry up towards the holdco, for example. And that does take time. So every day that goes by, or every week that goes by, we get closer to the point where TLAC will be in place, not just in quantum, but in amount. And we actually give the figures in the annual report in terms of orders of magnitude of what's been issued. Everybody is on track for the 2019 deadline. All the systemic institutions are on track, and some of them actually are effectively there. What the lessons, and I don't want to be drawn, if you don't mind, drawn on specific institution, specific bank situations, but I think there have been a number of lessons that have been reinforced. I don't think this is news, to be honest, but have just been reinforced by experiences in the last few years in Europe, is that it's not a great idea to have retail investors owning the debt that's going to be bailed in. And that doesn't matter whether it's AT1 or it's senior unsecured in a future structure. Now, that is a conduct issue as much as it is a financial stability issue. That's the first point. The second thing is that it is important, and this has been reinforced, that that the ability to stay counterparties, including on a cross-border basis, so derivative counterparties over the course of coming into and over the course of a resolution weekend is important. So the reforms that came into place a few years ago with the revised ISDA contracts, you'd be familiar with that, are crucial. And finishing the job on that, because there's some legislative aspects that in some jurisdictions are required, is important as well. And then the third thing that's important, which haven't really been tested thus far, are the cross-border aspects of internal TLAC and how that will actually function. And that's one of the elements of guidance that's being released from memory. Well, it's being released for this summit, but...
Only 2 days from now.
2 days from now, that's right, yeah. Sorry, asset manager. I'm sorry, I knew there was something else. Look, the focus on asset managers has rightly in, well, it doesn't matter what I think, but in terms of the view of the FSB, has rightly focused on asset management activities, a comprehensive set of recommendations, now in the process of operationalizing those. And then the question becomes, in the fullness of time, okay, is there residual risk that's left after having addressed those asset management activities properly? I think the expectation is the answer will be no, and there's a tremendous work plan that's involved in implementing those actual recommendations, and we're seeing the first element with the IOSCO work on liquidity.
I think we have one question from the phone line. Is that right, Joe? Two questions from the phones, please. Thanks.
First question from the phone comes from Jack Irving, New York Times. Please go ahead.
Yeah, hi. I just wondered, what are you actually looking for from the G20? Would you be looking for something in the communique that would endorse your recommendations? And secondly, would you be anticipating any resistance from possibly the U.S. government, which, as you know, has been talking about rolling back financial regulation? Thank you.
Okay, thank you. So I'll take that first. In terms of the reaction of G20 leaders, having been to a number of these summits now, they assess the work that the FSB has done, and they either welcome it or take note of it. They quite frequently provide a direction on a future work plan and an emphasis on certain activities which sets the agenda for the FSB. My expectation, if I may, is that a heavy element of the second part, in other words, on what should we be focusing, the FSB, will be around this issues around implementation and the effects of reform. And if I may, that links up with the second part of your question in terms of the priorities, as I understand them, of the U.S. administration, and my understanding is based on frequent conversations with the Treasury Secretary and the Chair of the Federal Reserve, and obviously informed by the Treasury report, and actually I would add conversations of other FSB members, the Chair of the SEC, as well as discussions, informal discussions with the CFTC. I think U.S. priorities in this regard are quite common to the priorities of others in the G20, which is a tremendous amount of progress has been made. How do all these reforms fit together now that we're implementing them? Where are there potential issues around overlap, underlap possibly, coherence across the reforms, and how can we most efficiently achieve the level of resilience that we're trying to achieve? And so on a range of issues, I'll finish with one example. I referenced in my opening remarks that it's likely that the first priority of our dynamic evaluation will be around the interaction between how the leverage ratio, which protects banks' balance sheets, how it's designed, and how that affects the incentives for central clearing, and central clearing, as you probably appreciate, makes a tremendous difference to the resilience and transparency of derivative markets. And there's an inconsistency in the views of many from the U.S., from the U.K., from other jurisdictions between those two reforms, and you need a table like the FSB which can weigh all the different factors and make a decision based on that. So that's the way I would square the circle. I think the direction that's going to come out of the G20 is very likely to be this focus on implementation, and then the point, I'll make one coda point if I may, which is that a message that we will deliver on behalf of the FSB, and it's contained in the letter which you're receiving today, is to try to get across that the progress that has been made, and it has been considerable, both in terms of the underlying reforms, but also in terms of supervisory and regulatory cooperation, that does create an opportunity to at a minimum maintain this open system, but potentially to enhance the openness and the effectiveness of the global financial system, if that's what leaders want.
We'll take that second question from the phone lines before coming back to the room.
The next question comes from Lucy Barton, The Telegraph. Please go ahead.
Hi. I just wondered what impact do you think any shift in euro clearing will have on the global financial system?
Speaking from an FSB perspective, the focus on clearing has been, and as you see in the reports that are coming to the summit, has been to ensure that central counterparties are as resilient as necessary, that they are efficiently resilient, if I can put it that way, and that we have in place the right policies to help them recover if they get into trouble, and if necessary, to resolve those institutions, because after all, they are private institutions, if that were to become necessary. Now, I would say on the last element, the clearer the way an institution would be resolved, the more likely that recovery mechanisms are going to be more effective. So that's the focus, alongside what I just said, with respect to the interactions of some of the other reforms and how they affect incentives. It won't surprise you that there's not detailed discussions about country or jurisdiction-specific policies, real or prospective.
One question here, Phil, and one question at the front here, after that. No, just here, Phil, I said.
One row in front.
One row in front. Thank you.
Thanks. Philip Stafford from the Financial Times. You said that shadow banking now is no longer a systemic issue, quite a move compared to, say, 5 years ago. Just want to explain a little bit more about your thinking here, and especially considering the sector is still continuing to grow.
Yeah, well, it's an important question, and one of the things that's drawn out, what I said was that the toxic elements of shadow banking are no longer represent a financial stability risk. So if we were sitting here 10 years ago, 9 years ago, the conversation would have been around money market funds, SIVs, asset-backed commercial paper, monoline insurers, elements of securitization, synthetic securitization, and all part of a massive liquidity maturity transformation scheme that was built on, sand. And what is shown in the report, the annual report, and it's backed up in much more detail in the shadow banking report, but Svan points out on page 24 of the report, you get a sense of the scale of what used to be toxic, which would have been, let's say 2/3 of shadow banking prior to the crisis, representing about
Less than a third.
Yeah, now represents less than a third, so gone from about 18 trillion to about 12 trillion. But the difference is that which still exists, if you think about the way money market funds are now regulated, particularly in the United States, where there's not a stable net asset value requirement, other reforms that have gone there. The way that securitization has been changed, including for banks and their so-called what's called step-in risk, the risk that they will have to step in and provide liquidity, which of course was one of the issues which caused the panic. The series of reforms around securitization, a number of things, the way we've changed the way repo markets function and haircutting in repo markets, a number of things have been put in place that means that what's left of that activity we think is resilient market-based finance. I mean, repo is an entirely legitimate activity. Repo of government bonds, repo of synthetic CDS securitization, which is where we got to in 2006-07, was not a great idea, was proved not to be a great idea. And now, without some changes to regulation, it would come back in a different guise. And so the point that we're making, or the call that we're making, is that we put in place these measures that both address the toxic side, keep the activity that is there and very worthwhile. And if you just, sorry not to guide you too much, but if you turn over the page 25, it goes through in some disaggregation what's shrunk, what's grown, what's relevant for each bid. And the big picture story, and I'll finish with this around shadow banking or market-based finance, as we kind of prefer to move to call it, is that asset management has grown tremendously, 50 trillion, 75 trillion today. And that's by and large good. But there are some risks associated with it, which is why we came out with recommendations earlier this year.
Hello, Kat Contiguglia from Politico. So you mentioned in the letter that you were concerned about regulatory fatigue, and I was hoping you could kind of elaborate on what parts of regulation are you worried that this could impact, and where do you see that fatigue potentially being destructive?
Yeah, well, I mean, it's natural. It's 10 years in. You're probably having press briefing fatigue by this stage in the FSB. It's a natural experience, but it's natural because memories of the crisis fade. Progress has been made. Sometimes the devil's in the details, and there are a number of areas where we've agreed all the international approaches on an international level. But then when it comes back time to implement domestically, other priorities can take precedence. Some of the examples, everything that we're concerned about, we highlight, both in the report and in the letter. Some examples would include around derivatives. I mean, this is a perfect example of the kind of thing that is fatiguing and detailed, but trade reporting, which is important, so that all trades, derivative trades, over-the-counter trades, didn't used to be reported. You didn't know what people were doing, which was part of the problem when, as soon as people's regulators and other investors started to care about it, they couldn't find out what the answer was. Now trades all have to be reported. They're being reported, but that information is not always being shared with people who need it. There's legal barriers, and sometimes it's just slowness in getting regulation in place, the right regulation in place. So in the derivatives reports, buried in them are naming the relevant jurisdictions and what they need to do. There is a timeline for that, and we need that level of focus to just make sure that people do things in time in order to get there. Basel III would be another example where we're down to just a few issues, those who are negotiating this, and we need to finish the job because it makes the whole package that much more coherent. And then the last thing, which is not so much a fatigue issue, but there's always a risk of some complacency. We fixed the issues, we think. We fixed the issues that caused the last crisis. They were pretty fundamental and deep-seated, so that's why it's been such a major job. But there will be new risks that evolve and come out of the system. And since those risks haven't manifested themselves in a real tangible way that causes a depression and people being thrown out of work, maintaining the political backing to address those risks is important. I would say, to the credit of the G20, that they have maintained that backing. They have maintained that focus. And an example on that would be issues related to asset management. Again, asset management is very fundamentally positive development, but there are some issues that one can anticipate could go wrong. And we've received the backing on that, and we have to deliver the substance behind it.
One question here, and this gentleman here.
Hi, Tom Porter, S&P Market Intelligence. Can I ask, has easy monetary policy globally contributed to the risk you highlighted in the asset management sector, particularly as you referenced open-ended funds, I think, in the report? And what are the risks if and when we enter the tightening cycle? Thanks.
Yeah, I wouldn't put it down to that. I would also highlight that. Just to make a meta monetary point, easy is relative. Use the term easy monetary policy. It's just unprecedentedly low interest rates, which is different than easy monetary policy. Because after all, the challenge in the last decade has been an absence of inflation. That's been the fundamental challenge. So just in terms of end result, and I'm not talking about any specific jurisdiction, I'm talking about the global markets. I think the challenge and the view of others in the FSB and asset management is, or one of the risks in asset management, I would say, is that there has been this growth, there has been an extension of assets in pools where you get daily liquidity for assets that, as you can appreciate, aren't necessarily going to be liquid in a more prolonged market adjustment. And it's that mismatch which it's first and foremost the responsibility of the asset manager to serve their clients well and to manage liquidity and expectations accordingly. But in some cases, we're finding that they don't necessarily have the tools in order to do that. And there's a coordination problem in making sure that they can have the tools, and that's where the work of IOSCO and others comes into play.
Thanks. Patrick Henry from Bloomberg. You said that we need a decision, a deal at Basel urgently. The Bank of France has made clear its opposition to the current proposal on the aggregate output floor and says that Germany and the Netherlands are with it. How great is the risk, do you think, that they can't find a decision, a compromise at Basel? And for financial stability globally, what would be the risks of no deal on the last bits of Basel III?
Yeah, I think it's look, I think a deal is possible, and knowing the positions of all the, knowing the positions of all the parties, I think a deal is possible. I think it's going to take a bit more time over the course of this year, but it should all the parties should be fully engaged in this process and working to finish this off. It is down to a relatively limited number of issues. Tremendous progress has been made in the whole Basel III process, but also tremendous progress has been made in this last issue, which is around, as you know, reducing excessive variance in risk weights. How important is it? Look, I think it is important for, I won't understate it, I think it's important for leveling the playing field. I think it's important to enhance confidence in the quality of bank capital. I think it's you know, Basel has solved 80% plus of the issues around Basel II. What's been agreed thus far gets you another maybe 10 percentage points of the way. So what's left is important, but it's not decisive. But to be frank, I think what's important about it is that if there weren't to be an agreement, and I expect that there will be an agreement, but if there weren't to be an agreement, just in terms of symbolic importance and issues around momentum, I'd be concerned about that. But I think that the countries you reference, the institutions you reference, are fully apprised of that, and they're committed to do their best to try to get an agreement.
One question down here, and then Larry.
Thanks very much from MLEX, John Riga. Just on the subject of some things where we've been looking for agreements that maybe some momentum may have been lost. Do you have any concerns, or could you just say maybe what sort of concerns you might have about hiccups in the Euribor reform, also the international capital standard for insurers, and also we remember hearing about on the issue of bonus policy that there would be some sort of a global mediation body. Has anything ever come of that? I'm just trying to find a way to package those questions.
Yeah, no, working back from that. And I'll make a meta comment, which is first on the compensation. When is the report coming?
It's coming out tomorrow.
Tomorrow, yeah. So there is an assessment on the implementation of the compensation recommendations with a particular focus around how they affect incentives for good conduct, or put it another way, to what extent do they disincentivize misconduct. So there might not be a global, I actually don't recall this idea of having a global body. I'm sure Svein does, but I don't recall that. I mean, in general, the way we've worked is to get, as you know, is to get to agreed international standards, and then people go home and they implement them, or they don't, and they're subject to peer review and transparency and assessments of how well they do. So that'd be my answer for that. In terms of the issues around benchmarks, your first question, Look, I actually think there is serious progress being made in terms of best, and it's been catalyzed by the FSB around best practice, around benchmarks, and within various jurisdictions that is being mapped into action. You would have seen here in the UK announcements around Sonia in the last few weeks, and it's all consistent with progress there. So I just stay in the course on that. I wouldn't send a signal of concern from the FSB about this. We still need to move forward. But you gave 3 examples. I can't remember your second. That was. Oh, insurance. Yeah, insurance. Well, those discussions are ongoing, and there has, it's a big deal, obviously, to get an international insurance standard. But there has been, and it's referenced in the report. So I don't know. Do you want to?
If I could pick up on the point about an arbitration mechanism on compensation. When we issued these standards and principles in 2009, I think it was, there were complaints from the industry that unequal or inconsistent implementation meant that staff could be bid away. And we set up a mechanism whereby firms could alert us so that there could be a conversation between relevant supervisors to address that issue. And that mechanism has not been used.
But
so the mechanism exists, but it's not been used.
I think the general point I'd make is that there is still a lot of goodwill, momentum, expertise around the reforms. And so at meetings of the FSB, people are fully engaged, there's lots of work going on, and people are doing their best to try to get this right. First point. Second point is that the nature of the work, though, is shifting, as you'd expect over time. There has been, over the last decade, a lot of new measures agreed, and now the focus is increasingly around implementing those measures, making sure that people are implementing, and adjusting as implementation takes place, because you learn more as you implement. And in some cases, here's a surprise, we don't have it perfectly right, and things need to change, or that the interaction between various reforms means that one or the other should be adjusted, or finally that the system itself has evolved, which is natural, and we need to take steps to address it.
Larry, last question.
Larry Elliott of The Guardian. You said earlier that it's 10 years since the financial crisis started, and no one back then thought that the US subprime mortgage market would blow up the world. What should be keeping us awake at night now, or is it really different this time?
You want me to be a hostage to fortune. You just want me to say that. You want me to say that, so you can fling it back at me. Look, what keeps us up? One of the things that concerns us because of the scale of the development are these issues around open-ended asset managers supplying a substantial proportion of cross-border flows into emerging markets and developing economies at a time when, and the growth in those flows during a period where there's been considerable liquidity in those markets. I don't mean central bank liquidity, I mean liquidity in those markets. In other words, that it has appeared more liquid than it will likely appear under stress. And so the question is, what will the consequences be when inevitably there's a period of sharp adjustment, reduced liquidity, and what could the knock-on effects be, first and foremost for those economies, but also for the system as a whole. And that's why there's been, and the best in the asset management industry absolutely get this, and they try to manage to those risks. And we're trying to globalize, internationalize best practice, and that's what IOSCO's concerned about. The second thing, which doesn't keep us up at night, but gnaws at us, is the opportunity. I can put it in positive or negative, but there has been tremendous progress that I do believe, and people around the table believe, that the standards have been materially improved. materially improved. And the level of cooperation, information sharing is substantially better. So the positive is, okay, to what extent are we going to realize the benefits of this? I'd rather have it in the positive. Are we going to fully reap the benefits? A strategic choice for the G20. I can put it in the negative. To what extent could this system fragment despite that progress, and we actually lose the progress that's been made at a time when it's absolutely not necessary?
I'm afraid we're out of time.